Let's review chapters 5 through 9 and 11. So this first question that we'll be working through is from chapter 5, when you learned about merchandising operations. So it says, Summer Company sold $1,000 of merchandise to Wilkes Company, FOB shipping point, terms 210 net 30. The goods cost Summer Company $650. So we're first going to talk about just the journal entry or journal entries that we need to make for this sale. So whenever you're a merchandising company, you have two different entries for the sale. The first entry is going to deal with what you sold the merchandise for, right? So what are you getting as the seller, and how much revenue did you make? The second entry is for how much those goods that you sold originally cost you, right? So the cost of the goods sold. So we have those two entries. So this first entry will be accounts receivable debited for $1,000 and sales revenue credited for $1,000. So the first entry will be accounts receivable and sales revenue, because that's the amount of money that we sold this merchandise for. So we want to count all of that revenue under our sales revenue. And now, how do we know that it's accounts receivable and not cash, let's say? Well, those terms. When you are given terms like that, that means that it was a sale on account. So we debit our accounts receivable because Wilkes Company owes us $1,000. So that's for the selling price, right? The second entry, this is for the cost of these goods. So we debit cost of goods sold. Cost of goods sold is an expense account. So that expense is increasing here with this debit. And then we need to credit inventory. What does crediting inventory do? Well, inventory is an asset. And so if we credit an asset, it's decreasing that balance. And why does that make sense? Well, if we were to sell goods to Wilkes Company, we now have less inventory in our warehouse, right? So our inventory here has to decrease. So we decrease our inventory by this $650. So those are the two entries that are made when you make a sale. First, we deal with the credit sale itself, right? We say how much does the buyer owe us and how much in revenue did we make. The second entry is how much were these goods worth to us, right? What was the cost of those goods sold? And how much inventory did we sell? So those are your two entries. Now let's go back up to the original problem and talk about a few of these points in here. First, FOB shipping point. What does that mean? Well, under FOB shipping point, that means that the buyer has to pay for the shipping. So in this example, Wilkes Company would have to pay for the shipping. And whenever the buyer pays for shipping, they count that under inventory because it was an additional cost to them in order to acquire that inventory. Now, the other option here would have been FOB destination. In that case, the seller pays for the shipping. And in that journal entry, we would end up debiting freight out, which is another expense account. So that deals with who pays for the freight costs. And then this next point, terms 210 net 30. So we said earlier that that was the key that told us that it was on account. Now why? Well, if we break out this little phrase here, what this is saying is that if Wilkes Company pays within 10 days, they get a 2% discount, right? So terms 210. So a 2% discount if they pay within 10 days. Or they have to pay the net, they have to pay all of it within 30 days. So terms 210, net 30. So why does that mean that it's on account? Well, because we're talking about if they pay within 10 days or if they pay within 30 days. So that means that they didn't pay at the time of the purchase. So these terms have replaced the little phrase where it would say the sale was made on account. Now, why would a company give these discounts, right? Why would Summer Company want to give Wilkes a 2% discount? Well, they want to get their money now, right? So Summer Company was willing to give Wilkes a little bit of a discount, just a 2% discount, if they paid quickly, right? If they pay within the first 10 days. So it's just a way to motivate a buyer to pay the money back that they owed. Now, when this discount is recorded in a journal entry, if we were Summer Company, we would record that 2% discount under the account sales discount. If we were Wilkes Company, if we were the buyer, we would record that 2% discount under inventory. So now let's talk about perpetual inventory. So this is when you started working into chapter 6. So you started to learn about FIFO, LIFO, and average cost, right? FIFO's first in, first out. LIFO, last in, first out. And then average cost, we combined all of our inventories to figure out a average unit cost, right? So one piece that's really important here, when you are working with FIFO, LIFO, or average cost, you only pay attention to the cost. You might be told a selling price, but that selling price is not important to us. When we need to figure out the cost of goods sold and the ending inventory under each of FIFO, LIFO, and average cost, we do not worry about that selling price, right? If we take a look back at the journal entries that we just did, we would only care about that 650. We would only care about the 650 for cost of goods sold and the 650 for inventory. We would not care about that $1,000 amount. And that is true for FIFO, LIFO, and average cost. Now, what are some of the benefits of FIFO and LIFO? Well, FIFO is going to give you a lower cost of goods sold. And we said earlier, cost of goods sold is an expense. So if you have a lower cost of goods sold, you have a higher net income. Right? So a company using FIFO is going to show a higher net income. Now, what about LIFO? Well, LIFO gives you a higher cost of goods sold. So that means you're going to have a lower net income. So that doesn't sound very good, right? Well, if we have a lower income, that also means that we have less in taxes. So if a company is using LIFO, they'll be having to pay less in income taxes. So average cost is going to be somewhere between your FIFO and LIFO amounts. It's not going to be as high of a net income or as low of a net income as you would see in FIFO and LIFO. It would just be somewhere in between those two. Now, a company cannot just switch back and forth, right? They're not going to say, oh, well, in 2019, we're going to go with FIFO, 2020, we're going to go LIFO, and 2021, we're going to go with average cost. They have to go back multiple years and redo all of their financial statements to show what would our net income have been if we use this new inventory method, right? So a lot of companies are going to pick one method and stick with it. Now they can make a change, but if they make a change, they're then going to stick with that new one and not just constantly make changes year after year. Now in chapter 7, you started learning about special journals. So we had a few different special journals, right? We had the sales journal, the purchases journal, cash receipts, cash payments, and the general journal. And then you had to identify which journal a bunch of transactions would fall into. Right? So when you're working with special journals, I want the first question that you ask yourself to be, is cash involved in the transaction? If cash is involved, you will either record it in the cash receipts journal or the cash payments journal. If cash is not involved, then you know that it's either going to be sales, purchases, or the general journal. For something to go into the sales journal, it needs to be a sale of merchandise on account. For something to go into the purchases journal, it needs to be a purchase of merchandise on account. And then adjusting, closing, and correcting entries would all fall into the general journal. So we'll go through a few transactions here and figure out which special journal they should fall into. First, cash sales. So we made, let's say, $1,000 in cash sales. Which journal would that fall into? Well, again, the first question, is cash involved? Yes. So we know it's either cash receipts or cash payments. Well, cash receipts are when we receive cash. Cash payments are when we pay cash. So if we're making cash sales, we are receiving cash, so it would go into your cash receipts journal. Next one, credit sale of merchandise. So we think, is cash involved? No, right? It's a credit sale. So then we can fall under sales journal, purchases journal, or general journal. Well, the sales journal, we said, were any sales of merchandise on account. Another way to phrase that is a credit sale of merchandise. So this one's going to go into the sales journal. Now, owner withdraws cash. Is cash involved? Yes. So it's either cash receipts or cash payments. Is the company getting cash or is the company losing cash? Again, we don't look at it from the perspective of the owner. We look at it from the perspective of the company itself. And when an owner withdraws cash from the company is losing cash, so it's the cash payments journal. Now, purchase of merchandise on account. So we ask ourselves, is cash involved? No, right? So it's either going to be the sales journal, the purchases journal, or the general journal. Well, it's not the sales journal because we said that was any sale of merchandise on account. What about the purchases journal? We said that was any purchase of merchandise on account. So this is the definition of what goes into the purchase journal. Now, cash purchase of land. So, again, the first question, is cash involved? Yes. Then we think, are we getting cash or are we losing cash? Well, if we are buying land, we are paying cash, so this goes into the cash payments journal. And then our last one, our equipment depreciates. So if we think back to when we learned about recording depreciation, right? When we debit depreciation expense and credit accumulated depreciation, that's an adjusting entry. And we said earlier that adjusting entries, along with closing entries and correcting entries, all fall under the general journal. So those are your special journals, right? The sales journal, the purchases journal, the general journal, and then your cash receipts and your cash payments. Now, in Chapter 8, you learned about bank reconciliation. And why does a company even deal with bank reconciliation? Well, the amount on their bank statement of the amount of money that they have might not match what their books say, what their ledger would say. And that's not good, right? Because you have a definitive amount of cash. So if they don't match, something's up, right? So you do these bank reconciliations to adjust these cash balances, so that way your adjusted cash balance per bank and per books equal at the end. So we have this example problem here, and it says Terry Davidson is unable to reconcile the bank balance at May 31st. Correct the errors in Davidson's reconciliation below. So what Terry Davidson did wrong was putting these adjustments in the wrong spots. We need to fix that. So we'll start off with the same cash balance per bank and cash balance per books as the example problem has. Then we need to think about what would get added to the cash balance per bank. Well, so this is going to be something that the bank doesn't know about and would increase the balance in your bank account. So that's going to be a deposit in transit. So what is a deposit in transit? Well, this is going to be any time that you have recorded a deposit in your books, it just hasn't gotten to the bank yet. You can even think about it as you just recorded it in the ledger and you're currently on the way to the bank. That deposit is in transit, right? You know about that $530. The bank doesn't know about it yet. So once the bank finds out about it, it's going to be added to your bank balance. Now, what would get subtracted from your cash balance per bank? So again, this is going to be something that the bank does not know about and would decrease the amount of money in your bank account. So that's your outstanding checks. So what is an outstanding check? Well, let's say you loved this review so much and you thought, hey, Stephen, you know what? I'm going to write you a check for $730. But I get this check and I just hold on to it for a little bit. To you, you've written that check. You don't have that $730 yet. But until I take that check to the bank has no idea that you wrote down on a piece of paper that you're giving me $730. Right? So until I take that check to the bank, it's an outstanding check. Because it's still out there in the world. So the bank would not know about that. And once they find out, it's going to decrease your bank balance. Right? So that's why we subtract it here on the bank reconciliation. So now our adjusted cash balance per bank. Well, we're going to take our initial cash balance per bank, that $3,560, and we add in the deposits in transit, and we subtract out the outstanding checks. And we'll get an adjusted cash balance per bank of $3,360.20. So now we can take a look at the cash balance per books. Well, we know that the only two adjustments left are the NSF check and the bank service charge. So those are going to go over here on the cash balance per books. But we just now need to figure out where they would go. So let's talk about an NSF check first. An NSF check is going to be subtracted from your cash balance per books. And why? Well, an NSF check is when you receive a check that you thought was a good check, but then realized after you deposited it, it bounced, right? NSF is not sufficient funds. So it's a check that someone else wrote to you, and that person did not have enough money to write you this check. So we have to now subtract this $490 check that we got off of our books, because we never actually got that money. Now, our only other adjustment here is a bank service charge. So we think about this as we may have known that a bank was going to charge us $25 here, right? There might be some monthly fee, but we hadn't recorded it yet. So we need to adjust our books to account for this bank service charge. Now, would this add to or subtract from our cash balance per books? It's going to subtract from it, right? If the bank charges you $25, there's no world where that is going to add to what you have in your bank account, right? So it's going to take away $25 from your bank account. So we need to subtract that $25 here. Now, it's okay that we don't have anything that's going to add to our cash balance per books. But what sort of scenarios could there be? Well, a common one is a note collected by the bank. Right? So if we were told that the bank collected a $500 note with $50 interest and a $10 fee, we would have to record that under the add section of our per books as a note collected by the bank. And then the amount that we would include would be the face value plus the interest minus the fee. So that's how we would figure out the number that would go on our bank reconciliation. But here, we didn't have anything that was going to add to our per books side. So let's figure out our adjusted cash balance per books. So we take our cash balance per books, that $38.75, and we add, or we subtract out our NSF check, and we subtract out our bank service charge, and we get $3,360.20. That number looks familiar, and why is that? Because it's the same as our adjusted cash balance per bank. It's not a coincidence. It's why we did all of this work, right? We wanted to be able to show that our cash balance per bank is the same as our cash balance per books, because we have $3,360. Whether you look in our ledger or you look in the bank. Now, another part of bank reconciliation are journal entries. You would need to journalize only the adjustments on the per books side, right? Because those are the adjustments that you are making to your books, to your ledger, and so those are the ones that would have to be journalized. So we would need to make journal entries for the NSF check and the bank service charge. Now let's move on to the allowance method. So you learned about the allowance method in Chapter 9. So this is a way for companies to estimate uncollectible amounts, right? In a perfect world, everyone's going to pay you back everything that they owe you. Unfortunately, that's not how it works in the real world, right? So a company uses these methods in order to account for that, to figure out what can we expect to be an uncollectible amount. So under the allowance method, we have two different ways of doing this. We can do it the percentage of sales basis or the percentage of receivables basis. So we're going to do both of those here in this problem. So it says the ledger of Preston Company at the end of the year shows accounts receivable with $175,000, sales revenue $550,000, and sales returns and allowances $35,000. Then, if allowance for doubtful accounts has a credit balance of $2,100 in the trial balance, we need to journalize the adjusting entries at December 31st, assuming bad debts are expected to be, first, 1% of net sales, and then we'll do this problem again under the percentage of receivables basis and say that our bad debts are expected to be 10% of accounts receivable. So before we even start thinking about the adjusting entry itself and the journal entry, we need to first figure out the numbers to use in this entry. So we're first working on this 1% of net sales. Well, we weren't given net sales, but we were given the pieces to find net sales. So we take our sales revenue and we subtract out our sales returns and allowances. So $550,000 minus $35,000, and your net sales will be $515,000. So we're saying that our bad debts will be 1% of that, right? So what is 1% of our net sales? So we take 1% of $515,000 and multiply it by 0.01, and we see that 1% of our net sales are $5,150. So we can now look at our adjusting entry. Your adjusting entry will be a debit to bad debt expense and a credit to allowance for doubtful accounts. So allowance for doubtful accounts is a contra asset. It goes against your accounts receivable. Now, we were initially told that our allowance for doubtful accounts has a credit balance of $2,100. When you are working in the percentage of sales basis, you don't even worry about that number. That $2,100, that's going to come into play once we do the percentage of receivables. But in this case, we just toss in that 1% of net sales into your bad debt expense and your allowance for doubtful accounts. So now, let's look at part 2, right? Assuming that bad debts are expected to be 10% of accounts receivable. Well, they gave us our accounts receivable, right? So we take 10% of that. So $175,000 times 0.10, that's the 10%, and we find that that number is $17,500. Now this is where that existing balance in allowance for doubtful accounts is going to come into play. We make a T account. Right? We make a T account for our allowance for doubtful accounts. And it told us that it started off with a credit balance of $2,100. So we put that into our T account. And then we just found the 10% of accounts receivable. That's what we want the ending balance to be in allowance for doubtful accounts. So we're starting off with $2,100 on the credit side, and we want to end with $17,500 on the credit side. So how much do we need to credit allowance for doubtful accounts to get from $2,100 to $17,500? Well, to do that, you subtract those two amounts, and you'll see that you need to credit an additional $15,400. So now we have everything that we need to journalize our adjusting entry. The framework of the entry is exactly the same. You debit your bad debt expense and you credit your allowance for doubtful accounts. For how much? $15,400. The amount that you had to adjust your allowance for doubtful accounts for to go from that beginning balance to the ending balance that you calculated. Now let's move on to chapter 11, where you started learning the difference between gross earnings, net pay, you started learning about some taxes, right? So gross earnings, what are gross earnings? Well, that's going to be the total amount earned by the employee. So if you think of this as the number of hours worked times your hourly wage, right? If you worked 40 hours this week and you make $10 an hour, your gross earnings would be $400. But your gross earnings is not what your paycheck is probably for, right? Your paycheck is going to be what your net pay is. So that's the total amount received by the employee, or the total amount that the company has to pay the employee. And how do we get that? That's your gross earnings minus your deductions. So deductions are taxes, insurance, right? All of those things that get taken out of your paycheck, those are all of your deductions. So you subtract that from your gross earnings, and that's how you get your net pay. Now, if you have to record the journal entry for the pay for the period, your gross earnings will be your salaries and wages expense number, right? Expense earnings. You would debit that. Then you would credit all of your taxes payable, right? Let's say federal income taxes payable, FICA taxes payable, right? All of those taxes would be credited. And then you would also credit your salaries and wages payable. And that salaries and wages payable is your net pay, right? So net pay goes into the payable and the earnings go into the expense. Now, one of the taxes that you learned about was FICA taxes. So, you learned that FICA taxes were 7.65%. That's not just some random number. That's made up of two different taxes. You have 6.2% and 1.45%. So, what's that 6.2%? That's your Social Security tax, right? Now, this has a special limit on it, right? So, up to $117,000 in gross earnings per year. So, someone will have to pay Social Security taxes up until they hit that threshold. Once they make more than $117,000 in a year, they no longer have to deal with any Social Security taxes. Now, the 1.45%, that's Medicare. Now, with Medicare, there is no limit. If you make $7 million, every single dollar is being taxed for Medicare. Right? So, someone who is under that $117,000 limit is paying 7.65% in FICA taxes. Anyone above that limit of $117,000 is paying only 1.45% in Medicare taxes.